Well, welcome to our 2016 third quarter investment report. It's been 100 days since the Brexit scare, 3/4 of a year after the most recent Fed rate hike. The markets, once again, they confounded the instincts of nervous investors and went up instead of down. Last week, Fed Chairperson Janet Yellen told the world that the U.S. economy is healthy enough to weather a rise in interest rates. But the Fed governors met in September and declined to serve up the first rate hike since last December 15th. That was pretty reassuring news to Wall Street traders and investors in general, helping to provide yet another quarter of positive gains in U.S. stocks. The Wilshire 5000 Total Market Index, which is the broadest measure of U.S. equities, gained 4.5% for the third quarter and is up a little over 8% for the first 3 quarters of the year. Larger companies posted the lowest gains. The widely quoted S&P 500 index of large company stocks posted a gain of 3.3% in the third quarter and is up just over 6% for the year. Meanwhile, the Russell Mid-Cap Index gained 4.5% for the quarter, and it's up over 10% for the year. And small company stocks, as measured by the Russell 2000 Small Cap Index, gained just over 9%. So they're up just about 11.5% so far this year, while the technology-heavy NASDAQ Composite Index has gained just under 10% for the quarter. It's up just over 6% for the year. Now, looking overseas, the U.S. remains a haven of stability in a very messy global investment scene. That's quite a conundrum from how we viewed ourselves in 2008, 2009, isn't it, when we thought everything was falling apart. The broad-based IFA index of companies in developed foreign countries, which are countries like the UK and Germany and England, gained just under 6% in the third quarter of the year, but is still down about 1% for the first 3 quarters of the year. In aggregate, European stocks have lost almost 3% so far in 2016. And Far Eastern stocks are up just about 2% or so for the year. In contrast, a basket of emerging market stocks, which are domiciled in less developed countries, as represented by the IFA-EM, or Emerging Markets Index, gained 8.32% for the first quarter and are sitting on gains of just under 14% so far. The primary equity fund that we use, which is DFA Selectively Hedged Global Equity, posted a pretty good gain of about 6.5% for the quarter, so it's up over 8% this year. Looking at the other investment categories and asset classes we use, real estate investments, as measured by the Wilshire U.S. REIT Index, were down a little over 1% for the third quarter, but they're still up just under 10% for the year. The REIT fund that we use in our model portfolio, DFA Global Real Estate Securities, declined 0.09%, is basically flat. And it's hanging on to a gain of just under 13% for the year. Commodities, as measured by the S&P GSCI index, lost 4% of their value in the third quarter, but they're still up a little over 5% for the year. Interestingly, the commodity fund that we use, DFA Commodity Strategy, finished up a little over 3% for the quarter and is holding on to again double the index of over 11% this year. So we're pretty pleased about that. Looking at our absolute return investments, AQR Style Prima declined 2.4% for the quarter and sitting at a loss of just under 3% for the year. Ironclad Managed Risk posted a slight gain of just about 1% in the third quarter and is up about 0.5% for the year. Turning to our managed futures asset class, a Stebbin managed futures strategy drifted down 1.5% in the third quarter, but it's still maintaining a nice gain of 6.5% for the year. On the bond side, the interest rate story is essentially unchanged. Rates are still really low, once again confounding all the experts who've been expecting significant rate rises for more than a half-decade now. The 10-year U.S. government bonds are currently yielding about 1.6%. 3-month notes are yielding about 0.3%, while 12-month bonds are paying just about 0.5%. If you go out 30 years, you can get a 2.32% annual coupon yield. On the bond side or loaned side of our portfolios, DFA selectively hedged global fixed income, tacked on an additional 0.75% for the quarter, and is sitting at a gain of over 5% this year. DFA investment grade added 0.3% in the third quarter, and they're sitting on a gain of over 6% for the year. DFA inflation-protected securities gained 1% for the quarter, and they are up just under 8% for the year. And finally, in the bonds, our high-yield bond fund, Principal High Yield, had another solid quarter, up just under 5%. They're sitting at a gain of over 12% for the year. What's keeping stock prices high? While sentiment appears to be, well, let's call it restrained. Well, nobody really knows the answer. But a deeper look at the U.S. economy suggests that the economic picture isn't nearly as gloomy as it's sometimes reported in the press. Economic growth for the second quarter has been revised upwards from 1.1 to 1.4% due to higher corporate spending in general, and especially as a result of increasing corporate investments in research and development. America's trade deficit shrank in August. Consumer spending, which makes up more than 2/3 of the U.S. economic activity, actually rose a pretty robust 4.3% for the quarter. That's maybe due partially to higher take-home wages this year. Meanwhile, someone had told you 5 years ago that today's unemployment rate would be 4.9%. You would have thought they were highly optimistic. But after the economy gained 151,000 more jobs in August, unemployment remained below 5% for the third consecutive month, and the trend is downward. At the same time, average hourly earnings for American workers have risen 2.4% so far this year. So based on their reading of the Treasury yield curve, economists at the Federal Reserve Bank of Cleveland have pegged the chances of a recession this time next year at a low 11%. That's pretty low. They predict GDP growth of 1.5% for this election year, which, while below target, is comfortably ahead of the negative numbers that would signal an economic downturn or a recession. In general, a steep yield curve has been a predictor of a strong economic growth, while an inverted one, where short-term rates are higher than long-term yields, are associated with a looming recession. On top of everything else, corporate profits have been on the long-term upswing, even if the rise has been choppy since 2008. Now, will this long-term trend continue? Who knows? Someday it will end. We just don't know when. The returns have been so good for so long that many investors are really wondering, why are we bothering with foreign stocks? A recent Forbes column suggested the answer. Historically, since 1970, foreign stocks have outperformed domestic stocks almost exactly 50% of the time. Meaning, the long-term trend we've become accustomed to could reverse itself at any time. Nobody would dispute that the economic statistics are weak tea leaves for trying to predict the market's next move. It's certainly possible that the U.S. and global economy are weaker than they appear. But the slow, steady growth we've experienced since 2008 is really showing no visible signs of ending. And it's really hard to find the usual euphoria and reckless investing that normally accompanies a market top and subsequent collapse of share prices. So at the current pace, we might look back on 2016 as another pretty good year to be invested, which is really all we ask for. Thanks for listening.